Ready for a deep dive into investing wisdom? We're talking about Benjamin Graham,
Mhm.
the OG of value investing, author of the legendary The Intelligent Investor.
And trust me, this isn't just some dusty old investing manual. It's about timeless strategies, even for today's crazy market.
Totally, like how to become a truly intelligent investor.
Yeah.
And where better to start than the market itself, right? That unpredictable beast that everyone wants to tame.
Well, Graham would say it's less about outsmarting the market, more like understanding its rhythm. He had this analogy: the market is a pendulum, swinging back and forth between extremes.
Okay, a pendulum. So more than just like buy low, sell high.
Way deeper than that. One side of the swing, you have irrational exuberance, right? Think the dot-com bubble, or even those meme stocks a while back. Everyone's piling in, valuations go crazy, driven by hype, not really analysis.
Yeah, sounds familiar, unfortunately.
Yeah,
And then on the flip side of that pendulum swing.
that's where the undue pessimism takes over. The mood gets sour, everyone's afraid, and suddenly, good companies are being sold off for bargains. That, Graham argued, that's where the real opportunities are.
Okay, I see. So how do we, as intelligent investors, avoid those extremes of emotions, right? Do we have to become like masters of market timing, predicting the swings perfectly?
Well, that's the million-dollar question, isn't it? And Graham actually, he really went after this idea of market timing. He said even the pros, they can't predict those short-term market moves consistently.
Okay, so no crystal ball for market timing. So what's the alternative?
Instead of outguessing the market, he said focus on pricing, meaning really evaluate a business on its intrinsic value, like its true worth separate from those emotional swings. He believed over time a stock's price will, kind of gravitate toward that intrinsic value.
Okay, that makes sense. And this is where that famous margin of safety idea comes in, right? Like buying a company for less than it's worth.
Exactly. That discount, that difference between what you pay and that intrinsic value, that's your margin of safety. It's your buffer, right, against those market swings and even your own mistakes because, we all make them.
So if the market, like that pendulum, swings down and a good company's stock goes with it, that margin of safety, it's like a cushion.
Exactly. And remember, Graham wasn't just some theory guy. He was out there building his own firm on these principles, and he had this knack for sniffing out those undervalued gems.
Yeah. Okay, you've got me interested now. Do you have like a favorite example of Graham putting this into action, this pricing thing?
Yeah, one that always comes to mind is his analysis of Northern Pipeline Co. He found it trading for $65 a share, all right? But here's the thing, their bond holdings alone, just those, were worth $80 a share. The market was so caught up in some negativity, they missed this incredible value.
So Graham, seeing that disconnect, he swooped in and grabbed those shares.
You bet. And this wasn't a one-off. His whole philosophy was this: understand the business, figure out its intrinsic value, and then, wait patiently for the market to give you a good price, a price with that margin of safety.
It sounds so simple, but I bet it takes some serious discipline to actually do it, especially when the market's going crazy.
Oh, absolutely. Understanding how the market overreacts, both up and down, that's crucial for any investor trying to follow Graham.
It's amazing, how Graham stayed so level-headed in those crazy markets.
Yeah.
It makes me wonder though, like, how did he square this whole intrinsic value thing with those growth stocks everyone loves, especially in a market that's always chasing the next big thing?
Yeah, that's a great question, and it gets right to the heart of how Graham thought about risk. He wasn't against growth stocks exactly, but he was definitely wary of how much the market would pay for them. Remember, his whole thing was that margin of safety, right? And that gets tricky when a company's value is all about the future, not so much the present.
So is he just like avoid growth stocks?
Not really, no. He knew they could be amazing investments, but only, and this is key, only at the right price. A price that reflected how uncertain their future really was. He always said, be careful. Don't get caught up in the hype. Always come back to that intrinsic value.
Yeah, I can see that being important today with, some of these tech companies. Their valuations are sky high.
Yeah.
Easy to get swept up in it all, but Graham would probably say, slow down, look at the fundamentals.
100%. He'd probably point out those companies, yeah, they might have huge potential, but that potential is already in the stock price, often way too much even. He'd rather buy a company making money now, trading for less than it's worth, even if it's not growing as fast.
Those undervalued gems we were talking about. Okay, so say we've, done our research, found some good companies, ready to build our portfolio.
Yeah.
How did Graham suggest we actually structure it?
This is where his defensive portfolio comes in. And don't let the name fool you. It's not about hiding from the market, waiting for it to crash. It's about building something resilient, can handle those market storms while still making you money over time.
Gotcha. So what are the key parts of this defensive portfolio?
For Graham, bonds were number one. He saw them as that stabilizing force, providing income, preserving your money when things get volatile, like the ballast in a ship, keeping it steady in rough seas.
I get it. But bonds, they have a reputation for being, well, a little boring compared to those, exciting stocks we talked about.
Yeah, they get that a lot. But Graham would say there's beauty in that stability. Remember, minimizing risk, maximizing returns over the long haul. That was him. And bonds, they were crucial for that.
Okay, so bonds are the base. What else did Graham like in this defensive portfolio?
He wasn't afraid of stocks, but he was picky. He liked well-established companies, long history of profits, strong financials, and, this is important, a track record of paying dividends.
Dividends, another one you don't hear much about these days, especially with, like, the tech world. Why were they so important to Graham?
He saw them as proof, almost. Proof that a company was healthy financially and that they cared about their shareholders. He wasn't just looking for growth, remember? He wanted profitable, shareholder-friendly companies. Dividends showed him both.
He really was all about looking past the hype, the stock price, and really understanding the business itself and the people running it, huh?
Absolutely. He always said investors should see themselves as owners, part owners of the businesses, not just like gamblers trying to make a quick buck. He believed in research, careful analysis, and a long-term view.
So for those of us who aren't, financial experts, are there any specific like tools or strategies he recommended?
For evaluating companies and their management. So we've talked about Graham's big ideas, right? Like, the market swings, that margin of safety, building a portfolio with strong companies. But how do we actually like put this into practice? Where do we even start looking for those undervalued gems?
That's where the real work starts, and Graham knew that. He was all about, rolling up your sleeves, digging into those financial statements. Okay, so this is where I need like an accounting degree.
Right. Not at all, actually. Remember, Graham's whole thing was investing should be for everyone, not just Wall Street.
Okay, that's good to hear. So those financial statements, where do we even begin? What was Graham looking for?
He had a few favorites, and they're pretty straightforward. One was the price-to-book ratio, PB, they call it. It basically compares the stock price to, like, the value of the company's stuff, its assets, if they just shut down today.
So if it's low, that can mean the market's undervaluing the company, like finding hidden treasure at a garage sale.
Exactly. But Graham didn't just stop there. He looked at debt, too, like companies with low debt, meaning they weren't, borrowing tons of money, a sign of strength, he thought.
He really was about those fundamentals, huh? The stuff that gets ignored when everyone's chasing the latest trend.
Exactly. He also loved companies with, consistent earnings growth. Not the fastest growth, remember, but steady, reliable. Those companies could handle tough times.
You'll get rich quick schemes, just good, solid businesses. Makes sense. But even if we find those companies, they're still us, right? Our own psychology can mess things up.
You got it. And Graham knew that better than anyone. He even had a whole chapter in his book about the psychology of investing, how our emotions, can lead us astray.
And not just like panic selling when the market crashes.
Right. He also talked about greed, getting overconfident, chasing those hot stocks, ignoring the warning signs because you've been winning. He always said the market's a humbling place. Even the pros make mistakes.
So how do we avoid those traps?
He had some ideas. One was have a plan. Stick to it, even when you're emotional. Don't check your portfolio constantly, he said. Just creates anxiety and bad decisions.
Tune out the noise, focus on the long game. Good advice for like everything, really.
Right. And he stressed patience, discipline. Finding those undervalued gems, it takes time. It's not luck. It's doing your homework, being patient.
This whole deep dive, it's really about changing how we think, huh? Less about speculation, more about owning a piece of a good business for the long haul.
Exactly. That's the most important thing we can learn from Graham, that shift in mindset.
This has been amazing. So much to consider. As we wrap up, any final thoughts for our listeners? Something to like really chew on?
Remember, investing isn't just picking stocks. It's building a portfolio that fits your goals, your risk tolerance, how long you're investing for. And never forget patience, discipline, long-term thinking. That's what makes a truly intelligent investor.
Wise words. Thanks for joining us for this deep dive. Until next time, happy investing, everyone.